Hey everyone, and welcome back to the Rich Habits Podcast, a top 10 business podcast on Spotify. This is our question and answer edition, which means you send us questions via Instagram DMs at Rich Habits Podcast, email us questions at richhabitspodcast@gmail.com, or more importantly, you're a part of the Rich Habits Network, our sort of private community where we give that one-to-many experience to our biggest fans, and you get your questions answered both in there and on the episodes like today. We have a ton of questions, some questions about some person selling a business for $2.8 million, another person who's looking to, have, I think it's like $500,000 that they need to go invest, another question about how to protect your assets and structuring your LLCs and sort of your trusts and things like that. Another question comes from a 19-year-old who made $3,000, maybe it was $2,000, walking dogs over the last 3 weeks because they listened to our side hustle episode that we published about a month ago. So we have a ton of really fun questions. We can't wait to dive into them. But before we dive into that, got to give you guys a heads up. Interest rates are falling, but you can still lock in a 6% or higher yield with a bond account on public.com. And that's a pretty big deal because when rates drop, so can the interest you earn on your investment with those traditional high yield savings accounts.
A bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. So while other people are watching their returns shrink, you can sit back with regular interest payments.
But you might want to act fast because your yield is not locked in until you actually invest. The good news is it only takes a couple of minutes to sign up at public.com and you can go lock in that 6% or higher yield with a bond account. Again, that's only at public.com/rich habits. Again, public.com/rich habits. This was brought to you by Public Investing. They're a member of FINRA and SIPC. These rates are as November 4th, 2024. The average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. This is not an investment recommendation. All investing involves risk. Please visit public.com/disclosures/bond-account for more information. And I know, Robert, we talk about the bond account. We've talked about, how important it is to lock in rates like this. And I think it's more important than ever because we are now seeing another 25 basis point cut around the horizon here on November 7. So just here in a couple of days from the Federal Reserve, rates are going to go down in your high yield savings accounts, right? This is an opportunity for you to trade that 3.5% to 4% rate in your high yield savings account for a 6% or higher rate with a public.com bond account. So go learn more about it, do your own research, check it out. But we're just here to let you know what we're looking at and what gets us excited.
Yeah, we always talk about active management, and this is just that. You're basically flip-flopping from your high yield savings over to this bond account and keeping those yields high. It's very important to understand that you're not just going to sit back and expect one thing to be great for years and years. Sometimes you have to move your money around from account to account. That's why we love Public, because they do so many of these really great vehicles to keep those yields high, and I love it.
So let's jump into our first question. This one comes from inside the Rich Habits Network, and our question is by John B. John B says, "Hello, Rich Habits Network. I'm so excited to be here, and I've gotten so much value since joining. I'm combing the internet and my lawyer in figuring out the best way to structure my assets for maximizing protection. I have a holding company that holds all of my LLCs for each investment property that I have, 3 going on 4 now. I've signed up to start a business. Now my question is, do each business, example franchise in this circumstance, would I need to also put that in an individual LLC? And additionally, do you have any general tips or tricks on what the best structure is for those businesses? I have a trust that covers my holding company, and the holding company has all the LLCs. So I'm fingers crossed I don't get screwed on any of this, but would love Robert's advice." So Robert, I'll let you jump in on this one.
John B., you're on the right track. How I do it is a separate LLC for every property and every business. Then those LLCs are wholly owned by the holding company, and then the holding company is wholly owned by the revocable trust. That is the structure I use. That is the structure that all of the wealthiest people I know use. So you are on the right track, and the answer is yes. As you open more businesses, I always believe that it is best, as do my lawyers, to have each one of them in a separate LLC. Now, some people that buy a lot of properties and businesses will lump 4, 5, or 6 in one LLC. then open another LLC. I don't recommend that because even though operating individual LLCs costs a little bit more every month or every quarter for accounting or banking fees or whatever it might be, I like the fact that I have more insulation and more layering for protection, and that is the whole reason we do this. So I love where you're at. I would do it separately, keep them all separate, get them in the holding company, and then have the revocable trust own everything.
Okay, Robert, so walk the listeners through, though, why you should have an individual LLC and like all these sort of things going on behind the scenes and not just lumping them together, right? Let's say, obviously, you guys have the pizza restaurant. Like, what if someone slips and falls in the pizza restaurant and they go to sue the LLC? And inside that LLC, though, you also have assets of like 2 other rental properties. So are you saying that like if the restaurant gets sued, they can also go after the rental properties? Is that where you separate everything?
Yeah, that's always been my understanding. I've been doing it this way for 25 years, is because you want to be able to protect yourself personally and the assets from an inside or an outside attack. So an inside attack could be an employee sues you for something or whatever, and the outside attack could be someone slipping and falling on your property or whatever it may be. So the goal here is to control everything and own nothing. Please, everyone watching and everyone following along, to write that down. Control everything, own nothing. So by having these additional layers, you're protecting yourself. Now, you have to be careful though. A lot of people have LLCs, but they don't operate them correctly, and that allows the opposing counsel, the lawyers, to be able to do what's called piercing the corporate veil. So when you launch this LLC, make sure you understand you want to have a separate operating agreement. You want to make sure you have your EIN number. You want to have your separate bank account. You don't want to commingle funds. All of these things are very important to make sure that you are isolated and using the layering for what it's worth and what it's there for, to prevent you from being attacked personally, because the last thing you want them to do is pierce the corporate veil, win, and come after your personal assets. So that's why we keep it all separate.
And when you say control everything, own nothing, you're talking about Robert Croak, social security number, you sitting here in front of me right now, doesn't own X number of, rental properties and this pizza shop, things like that. But your companies, the LLCs, they are what own those things. You control those companies. So none of these things are in your name. They're in the name of these, LLCs and holding companies and trusts and things like that, of which you control all of those things.
100%, because at the end of the day, you never know, especially as you get bigger and bigger. The old song, "Mo Money, Mo Problems," is definitely something that comes into play, because when you become successful and the word gets out and you're building this big empire, people are going to come for you. They just are. It might be an employee, an ex-employee. It could be an ex-spouse or girlfriend or boyfriend. It doesn't matter. At the end of the day, you just want to structure everything properly so you can stay protected.
Now, I want to linger on this just a little bit longer. I know we've been talking about it for a while, but talk to me about, 1, what is an umbrella policy? And 2, are they important when it comes to figuring out the total protection that John B. might be looking for?
That is a fantastic question, and I never hear anyone talk about it. And for me, I keep an umbrella policy of $5 million at all times, just because I want to make sure I have that next level of protection. So if somebody does come after an LLC, comes after me, or something were to happen, God forbid, in a car accident, and the full insurances of the automobile insurance policy aren't covering, I have that umbrella policy, and it's exactly what you think it means. It's covering everything to help me better protect myself and make sure that I am covered end to end for any liabilities that could come up. And the cool thing about an umbrella policy, it can help you with legal fees. It can help you with so many different things over the years. It has been a godsend for me having these umbrella policies. And I don't think they're necessary if you're just starting out. But when you start building that net worth, the number one thing you want to do is just be protected. Because people are going to come for you, and you don't want to ever go backwards financially because of a frivolous lawsuit. I have had so many frivolous lawsuits over the years. We could spend a whole episode on that, of how I lost money or had to fight these frivolous lawsuits to protect myself. So it's very important for John B. and everyone listening, as you're building that empire, make sure you spend the time to understand these things and have them in place so you're fully protected.
Our next question comes from Zach M. Zach says, I'm looking for some advice or maybe some affirmation. Here's my situation. I'm 31 years old. I have a company 401k with a balance of $130,000. This is all in a target date fund, and I do not have the option to move that money into ETFs that we like. I only have the option for other target date funds. My minimum contribution to get maximum match is 10%. So at 10%, my company matches 50%. So I get a free 5%, which is what I'm currently doing. My other account is on public.com, and that's at $24,000. I have $12,000 in a high yield savings account with them, and the other $12,000 spread across SPYI, QQQ, VOO, and VGT. The $24,000 hits my emergency fund target at around 5 to 6 months of expenses. I do not have a Roth IRA or any other accounts besides my checking, which I keep 1.5 to 2 months of expenses in there. I'm currently saving around 5 to 10% a month on top of my 401k, putting my combined savings around 15 to 20% per month. With all that information, my thought was to stop contributing to my 401k and put the current 15 to 20% toward my bridge account and just let the target date fund 401k ride until retirement. My other thought is to leave it at 10%, get some free money, but my gut tells me I'm going to underperform with the target date fund over the next 30 years before retirement. So my analysis paralysis is this. How much would this free money cost me versus putting it all in a bridge account and building that up, knowing I can invest in index funds we all know and love? Really good question, Zach, and I'm going to let Robert kick this one off.
Zach, I love this, and just the fact that you're thinking it through so in-depthly and understanding, the opportunity cost of if you put all this money in the target date fund and it underperforms these ETFs and index funds that we talk about, what is the difference and what does it cost you over 10, 20, or 30 years? The answer is none of us know, but we can assume that let's say the average target date fund earns you 6% a year, but yet VOO or QQQ, let's say they average 10, 11, 12% a year. Well, we know then we have a 5% difference year in and year out over that 10, 20, or 30 years until you reach retirement. So for me, I would always do what Austin talks about. I would get just the match on the 401k, and I would get the rest of the funds into that Roth IRA, into that bridge account. You're only 31 years old, so you have a ton of time to really take advantage of the Roth and then put the rest into this bridge account and do that active management so you can perform really well over the years. And then also the bridge account gives you the flexibility of having money and funds that are available to you anytime you need them. So I definitely think you're on the right track, and that's what I would do. Keep the minimum of whatever the match is with the company, and the rest goes into the Roth and the bridge account, and you will crush it over the next 25, 30 years.
And Robert, just to kind of piggyback on what you said about the Roth IRA, Zach, you're 31. Let's say you just completely write off 31 years old and you don't start investing in the Roth IRA until 32. Okay. And you start maxing this out by investing $580 something toward it every single month. And then as it also increases over time, you stay maxed out and you continue to invest more and more at this, call it 10 to 12% annual return over the next 30 years, 35 years until 65. You're going to have $2.5 million of tax-free money waiting for you in retirement, all because you started maxing out your Roth IRA. Now, yes, you should absolutely, go up to the match with your 401k. You should get the free money. That's great. Go do that. That's fine. We talk about that. We teach that, but don't do it to the expense of maxing out your Roth IRA. We think you have enough in your sort of take-home pay here to max out your Roth IRA. If you don't have enough to max out that Roth IRA, pull back the 401k contributions just a little bit, because we do think the Roth IRA is going to outperform the 401k, considering it's going to be invested properly. It's not going to be holding cash, bonds, international stocks, commodities, everything else that comes with a target date fund. It's going to be invested into American capitalism, right? The S&P 500, the NASDAQ, VGT, VTI, MOAT, all those great index funds and ETFs that we talk about. And those will do 8, 10, 12%. Just year to date, the stock market's up 25% this year, and it was 28% last year. The markets are up 52% since the beginning of 2023. That is just Amazing. And so that's what we're trying to get you to be participating in, Zach. And we're not saying it's going to go up 52% over the next 2 years, right? I can't predict the future, and neither can anyone else. But I do know that over a long period of time, it tends to go up double digits, right? Call it 10 to 12%. And by having your money allocated correctly in these tax advantage accounts, you're going to be just fine. So don't worry about the analysis paralysis, Zach. You're crushing it, man, and we're rooting for you every single day.
And I want to add one more thing for everyone to understand. I know we hammer a lot on target date funds, but let's really break it down just for a second. And that is, target date funds are totally fine if you're trying to preserve money because they are built and structured in a way where they're not going to take a lot of risk, so they're not going to have a lot of volatility. And that is totally fine. But what I don't like about target date funds is I feel you leave too much money on the table over too long of a period of time. Now, if you were 51 and you built a decent nest egg and you wanted to have it in target date funds until retirement because you just didn't want to risk going backwards, I'd be okay with that. But at 31 years old, you have a lifetime of high earnings because generally the markets go up and to the right over time. And I just think it's a mistake because you'd be leaving too much money on the table. So keep that in mind. We definitely think you can overcome this analysis paralysis and crush it in the coming years, and we're here to help.
So our next question comes from Candace H. Candace says, "Hi, Austin and Robert. I'm looking for some investing advice. I'm in my 30s, have my CPA, and work at a CPA firm. I also help run a family business with my 2 brothers. I recently sold the business where we have equal ownership in the company. I've already received $400,000, and I'll receive another $400,000 to $600,000 at the beginning of 2025, all after tax. The only debt I have is on my house. I was lucky enough to purchase my house right before COVID, and since then, the housing market has really taken off. I bought my house for $216,000, and I currently have an outstanding mortgage on it at $149,000 with an interest rate of 4.75%. I've been told by a realtor that if I listed my house, it would go for about $305,000, maybe $315,000. For investing, I currently have $25,000 in treasuries, $464,000 in a high-yield cash account on public.com, and roughly $25,000 split evenly between some of the nuclear stocks that you guys mentioned in your last episode. I currently max out my contributions to a Roth IRA and HSA. I would like some advice on what you think I should do with the cash I've already received and will receive over the next couple months. My future goal is to grow my passive income where I don't have to work at all, but right now I'm focused on buying a new house with some acreage. Houses in my area with at least an acre of land seem to be going for $450,000 to $650,000 depending on the location. 1, what are your thoughts on how I should invest my money? And 2, what do you guys think about me taking this money and going out and buying my forever home with some acreage? Robert, I'll let you kick this one off.
Yeah, I love this. You're in a great situation. You just need to get a little more aggressive. In my opinion, right now, you have way too much money sitting in a high yield savings account. Some of that money needs to be mixed into these, blue chip funds that we talk about all the time, like VOO, QQQ, VGT, because those are going to perform well over time. And we want to make sure we're not leaving so much money on the table by having this amount in a high yield savings account. So that is one thing that I would do. Also, at your age in your 30s, I don't see any cryptocurrency. I think with this much money, you should have a small portion of it in Bitcoin, Ethereum, maybe some XRP and Chainlink. Get a small portfolio there as well to give you some exposure to that market. And then also, I love that you're thinking about this forever home, but I would just make sure you don't overdo it right now because your current living situation is really incredible. And if the market is going up on that property, maybe consider, because you have that property at such a low interest rate, turning that into a long-term rental. Keep getting the tax write-offs, keep getting the capital appreciation on that property, and then still go buy the other property. So those would be my takeaways. I just want to see you have more money diversified into the things we talk about all the time, rather than just these little tiny amounts, maybe in nuclear, which I think is a great sector. But we also want to make sure that you have these kind of boring investments that perform really well each and every year, like the S&P 500.
I liked all that, Robert. That's really good. Kind of just thinking out loud here, right? So if your current goal is to buy a house with some acreage, then sell your house that you live in right now at this 4.75% interest rate. Sure, is it a low interest rate? Yeah, it's kind of low. It's not high. It's not too low. It's like right in the middle, right? Let's call it 5%. Sell the house, which means that you would take home about $150,000, maybe close to $125,000 after everything's said and done there with your realtor. You already have $400,000 sitting in a high yield savings account. So now we have $525,000, and then you're going to get another, let's call it $500,000 in the next couple months, all after taxes. So we're talking about once you sell your house and look at your high yield savings accounts, just over $1 million. If it were me, I would do the following. I would park probably 500,000 of that into the S&P 500, NASDAQ, VTI, all these things that will allow it to grow, specifically double over the next 7 years, because the S&P 500 doubles on average every 7 years. So my 500,000 in 7 years will now be worth about $1 million. I'm going to take the other $500,000 and find my dream home, which means that maybe not spending all 500,000 on buying the house. I'm not saying buy a house in cash, but what I am saying is putting down enough of a down payment where that monthly mortgage isn't a crazy burden on you, but also having enough set aside where when you want to do those, that 80,000 renovation or that 100,000 renovation, and you want to completely redo the kitchen because it was built in the 90s, but it's sitting on 7 acres and it's all this perfect stuff for you. So have enough money set aside where you can also buy your dream house and renovate it with the other $500,000. And then whatever you have left, park that again back into the S&P 500, things like that we've talked about over here in the bridge account. Now we fast forward 7, 8, 9 years. You're now in your early 40s, I'd imagine, call it 42, 43. You have, let's call it $1 million, $1.2 million that is in this bridge account. You can immediately flip all of that into monthly income paying ETFs like SPYI, QQQI, BTCI perhaps, and these other NEOS funds that we talk about, allowing you to make 10 to 15,000 a month in passive income. So check, your long-term goal of passive income and completely retiring is done. And now 7 years down the road, you still have a mortgage on the house, which is fine, but the mortgage is now still low enough that it's not that impactful on a month-to-month basis for you. And number two, I'd imagine in 7 years, Robert, interest rates will have dropped on 30-year fixed mortgages, allowing you to refinance this for out of, let's call it the 7.5 where it's at right now, maybe closer to 3.5, 4.5, which will take you back to where you were pre-COVID there. So that's my quick money to go find that forever home, renovate it, turn it into something special, as well as park this money in the S&P